Today we're diving into a strategy that can potentially triple your returns in under 6 months. This is not a get-rich-quick scheme. LEAPS options are powerful tools, however, they do require a bit of understanding and careful execution. In this video, we're going to break down exactly what LEAPS options are and how you can unlock 3 times or 300% return. We'll cover the basics of LEAPS options and how they're different from regular options, why they can be a game changer in your portfolio, and we will walk you through a step-by-step trade. So, hey, whether you're a novice or a seasoned trader looking to level up, this video is packed with valuable insights. Guys, before we get started, be sure and download the free options workshop in the link below. It talks about the 2 main benefits of trading options over buying stocks. Also, do me a favor, hit that like and subscribe button down below so you're notified of future videos. What are LEAPS options? LEAPS stands for Long-Term Equity Anticipation Securities. Yep, it's a mouthful. The difference between LEAPS options and standard options is really the time frame. LEAPS options expire more than a year out and even up to 2 years until expiration, whereas standard option contracts expire weekly or monthly. Here are the key points to understand about LEAPS options. They function just like regular options, giving you the right to buy for calls or sell for puts shares at a predetermined price. LEAPS can be exercised at any time prior to expiration. They're available for both stocks and indexes, offering flexibility in your long-term investment strategy. And LEAPS are traded on the same exchanges as regular options and follow similar procedures for trading, exercising, and assignment. The main difference? Time. With LEAPS, you're looking at a much longer time horizon, which can significantly impact your investment approach and potential returns, as you will see. All right, now that we understand what LEAPS options are, let's dive into the strategy. We want to first select the right stock or asset, and we need to choose companies with strong growth potential and fundamentals, as well as maybe an upcoming catalyst that's going to move the stock price higher. So let's take a look at DraftKings, ticker symbol DKNG. The fundamentals are strong with the revenue increasing year over year and net income as well, and the balance sheet is strong with more equity than debt. The 52-week range is from $25 to $49, and right now it is trading at $38.46. And you can see right back here in March of this year, just a few months ago, it was up at 48. And look here at the 1-year target estimate of $49 on, and this is Yahoo Finance. And a lot of different analysts have the target price in a year at 49. I think we're going to get here in 6 months. Let's take a look at some of the reasons that this is an article from the Motley Fool, 3 reasons to buy DraftKings stock like there's no tomorrow, by James Brumley. And he talks about its shares are discounted right now. And again, it's talking about how the stock is still down 46% from its 2021 peak. So there's a lot of room to move. They talk about the $49 target price. And it's not just sports gambling anymore. That is their bread and butter. But they also have online casino games like roulette and blackjack, and they've got the many states in the U.S. plus Canadian, the province of Ontario as well, and its sports book is available in 25 states and Ontario. So the non-sports business gives DraftKings a second profit center to work with as well, and neither business really cannibalizes each other. So just in July, the online share of U.S. gambling revenue rolled in at 25.9% versus 19.7% in the same month a year earlier. So that's why I like DraftKings. After we select the right stock, we want to select the correct LEAPS call option. This is where the magic happens. Select a LEAPS call option with at least 12 to 18 months until expiration. Choose a strike price that's deep in the money and look for options with a delta of 0.70 or higher. This means the options price will move more closely with the stock price. So let's take a look at DraftKings on the tastytrade option trading platform. I use tastytrade and Moomoo. There's links down below. Let's we punch in DKNG right here in the upper left, and then we make sure that we're on the trade page right here between positions and activity. And then we're going to go out over a year, more like a year and a half. So I'm going to look at the December 19th, 2025. That is 426 days to expiration. I'm going to click on this right here and open up the option chain. Now, I'm going to go deep in the money. So the stock price is $38.43, and we're going to look in the money. So this is in the money, the lower price on the call side. The calls are on the left, puts are on the right. And we're going to click on, we're going to look at the 30 strike, so below the 38, and we're going to click on the ask or the buy to buy that 30 strike call option. And we're going to buy that. It says $13.85. However, the mid price is $12.50. So that is really controlling 100 shares. It's one option contract that we would pay $12.50 for, which is really for 100 shares, it's $1,250. So that's the cost for our deep in the money 30 strike call option, and it's $12.50. And remember I said look for a delta of greater than 0.7. So this is 0.76. So what that tells us is that's going to move similar to owning the 100 shares of stock. And it's going to be about 76% accurate with that move. If we go to the curve mode right here and we click on analysis, we can see as the stock price moves up in time, then we make money on the option. So if we get up to that $49 range, $49.50, we make $700 right here on that option. We hit review and send and place the trade. Step 3 is to implement the poor man's covered call strategy. So we start off and buy the deep in the money LEAPS option. Then we sell the nearest month out of the money call option against it. And then we do this monthly, rolling the call option and collecting profits as the stock price moves up. We collect profits on the LEAPS option, and we collect monthly income on the call option that we sell. Hey guys, if you'd like to receive a free guide that covers all the option strategies as well as managing them, go ahead and drop a comment down below and just say free guide, and I'll send you the link. So now let's take a look at how we implement that poor man's covered call option strategy by selling the call option monthly. So we've already got the December 2025 LEAPS option, the 30, on, and we've paid $12.50 for it. You can see that right here. Now let's close this up. We're going to leave that on, and that's this little green dot that shows that trade's still on. You can see the $12.50 right here. Now we're going to open up the November 15th. This is only 27 days to expiration, but we're going to open up that option chain, and now we are going to stay on the call side, but we're going to sell instead of buy the 40 call option. And you can see this $2.01. Bid or sell. We're going to click on that and watch this price $12.50 come down, because we're going to collect $2 on this. There it is, $10.46. So now we're paying $1,046, and we've got $200 in our account right away. So it's only costing $1,046 for this selling the call option. We're going to do this every month and collect, roughly a couple $100. We hit review and send, and this is how we place the complete trade as one trade. And we're buying the LEAPS deep in the money call and selling the 40 strike call option in November, 1 month out. Now the last step is managing the position, and we do this by rolling the short call out every month. And if the short call option that we sold against the LEAPS is tested as if the stock price moved up and got near the call option, we don't want it to be called away. So what we can do is roll out in the same month if it's tested, and then wait until that 10-day time frame until expiration or less, and then roll to the next month. If our LEAPS option gets inside the 1-year time frame, I'll look for a good day to go ahead and close that position out, so it would be on an up day when the price moves up, and then I will buy another on the next down day further out in time, closer to 1.5 to 2 years. This way, the time decay, which happens faster when we get inside a year, does not eat up our profits. So guys, why is this strategy so powerful, and why are we able to make 3 times our initial investment in just 6 months? Well, there's a few reasons. The first one is it's very capital efficient. We are using much less capital to control each 100 shares of stock. One option contract controls 100 shares of stock. So typically it's a little bit less than half the cost to control the same 100 shares than it would be to buy the stock outright. We're also utilizing leverage. So this lower cost to control that number of shares really helps us amplify our returns. And we're also generating income. So that's another reason we're selling that call option monthly and collecting income every single month. And then lastly, stock price appreciation. As the stock price moves up over time within that 6 months to a year period, the price of our deep in the money call option, the LEAPS option that we bought, increases in value. So we make money there as well. So guys, now you see how we're making on monthly income $150 to $200, although we're going to roll it a little bit early before it closes. So let's say we made $120 every month. That's $720 over 6 months period of time. And then if the price moves up to that $49 expected level in 6 months, then we make another $600, $700 in appreciation. So we're talking over $1,300, maybe $1,400 in profit on a $1,000 investment. So that's a stock double, 2x. But yeah, I know you said, Darren, you said 3x, right? Yeah, well, watch this. Okay, guys, well, hey, here's one of my accounts that I've been just trading one LEAPS option in DraftKings, deep in the money, and selling calls monthly against it. And here's proof on the right here. You've got the 180-day time period, and my profits were $34.65. So that is a stock triple. So that's proof that hey, this strategy works. It's one of my favorites. All right, guys, let's wrap this up. We covered a lot of ground in this video. We started off understanding exactly what the LEAPS option strategy was, what a LEAPS option is, and then we jumped into exactly how to implement that strategy in order to triple our returns. And then we finally showed a real example on the option trading platform of exactly how to do it. If you found this video helpful, don't forget to hit that like and subscribe button down below for more info and videos on option trading. Also, download that free options workshop in the link below. It talks about the 2 main benefits of trading options over buying stocks. Leave a comment. Let me know, what are you doing with LEAPS options? Are you utilizing them or a different strategy? And what stocks are you trading? All right, thanks for watching. I'll see you in the next video.